it's just like 1929, and this is not good. But this time it's even bigger. It's bigger than 29. I mean, a lot bigger. So whether it happens in the next month or two, I don't know. I think it's quite likely to happen by the year end. There just is not the bullion there to satisfy the potential demand coming out of institutions. And we should note that analysts at the big banks are now forecasting higher gold prices. But their investment managers haven't got any. So what do? I mean, where do they go? It's not there. Prices go through the roof. Crisis ensues. So I think this is the danger.
You're watching CapitalCosm. My name is Danny. It is October 1st, 2025, and what better way to kick off the month than with Alasdair Macleod himself. Alasdair, thank you so much for coming on the show, my friend.
That's my pleasure.
Let's go ahead and dive right in here, Alasdair. Before we started speaking and recording, you said there's some interesting things happening in the markets right now. Care to elucidate? Care to let us in on what you think is most interesting?
Yeah, well, particularly in precious metals markets. I mean, the thing that's fascinating is the squeeze on the system. I mean, they're not overbought, and a lot of the time you see, prices rising while open interest on COMEX is contracting. I mean, it's an extraordinary situation, and we're hitting new high ground in gold and silver in particular. And I mean, all this indicates is a lack of liquidity. And fascinatingly, the Stanford deliveries on COMEX, I mean, yesterday, the last day of September, I mean, it was absolutely huge, something like, 66 tons, 65 tons of gold, and, sort of over 1,000 tons of silver. I mean, these are enormous amounts for a market which was never intended to act as a delivery mechanism. And I think it sort of indicates that, people wanting gold or silver in size, they can't go to the refineries because they're all sold out. They'll deliver in sort of join the queue sort of thing. So the only alternative really is to go to the futures markets, pay a premium, if you like, to pick the stuff up and then stand for delivery. And that's what's happening. I think, in both cases, I think China has got quite a lot to do with this. In the case of gold, China has more or less cornered the gold market. I put out a note today analyzing how much gold China actually has, China and her citizens. And, if you want to read it, you can pick it up on my Substack. But I reckon, and I'm fairly confident of these figures, that China has something like 75,500 tons between it and its citizens. Bear in mind that it's been accumulating this since 1983. So we're talking about over a long period of time. Also in a big bear market between 1983 and 2002. And it was at a time when we were selling gold hugely. I mean, both we were selling not only our gold as an investors, but also the central banks were selling gold. And not only were they selling gold, but people were taking delivery of gold, leased gold, and selling it into the market and putting the funds into US treasuries. And the gold disappeared. Guess who was buying it? China. I mean, the point is that if you look at the above ground stocks of around about 200,000 tons, look at how much gold China has got. We're looking at 36% of all above ground stock. It's leaving everybody else short. It's a short answer. And so we're seeing the squeeze now. And, the major US banks, amongst others, are beginning to get bullish on gold. And they manage portfolios which have no gold. And, at the moment, while, the Magnificent Seven are soaring and, credit bubble is intact, perhaps underlying investors don't care too much. But when that pops and they've got no gold, they'll be looking at a very, very different situation. And I think that these banks are beginning to realize that they've got to have some gold. But if you look at just adding to the 0.5% which global portfolios own of physical gold, if you take that up by 1%, they've got to find 25,000 tons at current prices. It's not there. It is not there. And this buying is going to happen. Of that, there is absolutely no doubt whatsoever. So what we're seeing at the moment, which might be terribly exciting for the bulls, gold rushing up to 3,900 and, looking as people forecasting it's going to go 4,300 or whatever. That's just the start of it. This is actually, I think, a crisis developing within the precious metals market. And what we see in gold, we're also seeing in silver. The story in silver is obviously different, but China, again, has been a big player in silver as one of the leading global mining nations. Not only that, but over a long period of time, they've been importing silver doré, refining it, hanging on to silver, but using their clout to keep the price suppressed. That's no longer happening. So we've got shortages developing in silver now too, as far as Western capital markets are concerned. The fact is that pricing of these things is no longer under our control. It's all gone on to Shanghai. And what we're seeing the squeeze on the establishment, the people who are short, not just establishment. If you look at the commitment of traders figures, you'll find that even managed funds have short positions. They're net long, but they've still got some short positions. The swaps, obviously, a big net short. The liabilities that are mounting up on the shorts are just staggering, absolutely staggering. So, it's a squeeze on the system. And I think actually, Danny, what we're looking at, if you stand back, we're looking at the dying days of the fiat currency system. And, that basically means that after a period of time, it doesn't matter don't know how long it'll be, but I suspect it won't be all that long. Unless governments actually manage to pin their currencies to gold, they'll become valueless. They'll go down to close to zero. I really can't see the politicians even thinking that they need to protect their currencies. They're still spendthrifts. They're still, having huge, great deficits on their budgets. They don't care. They just complain that the markets need higher interest rates. Well, it's hardly surprising. You're going to need higher interest rates still. And meanwhile, everybody in the market, in this credit bubble, assumes that inflation is going to diminish. But the thing they get wrong is it's not, sort of prices, if you like, in that sense. It's the loss of purchasing power of the currency. That's what they've got to look out for. And if I'm right that we are in the dying days of the fiat currency system, then prices are going to soar in the next 2 years. And that is something which, of course, nobody expects. But it won't be prices going up. It'll be the value of currencies going down, their purchasing power collapsing. And, of course, as soon as people realize that, they dump the currency for anything they can get with it. I think that's the future. I'm very sorry to say.
Yeah. At the start of the podcast, you mentioned this massive volume standing for delivery. Are we at any real risk of seeing a failure to deliver?
Well, it's not impossible. I think we have to, if you like, divide out bullion banks from others in the market, as it were. Bullion banks will try and run a balanced position as much as possible. Where they're short on COMEX, they're probably long in London. sort of thing. But when you got hedge funds, when you got people, sort of, and maybe market makers just making a market in the swaps rather than having positions in London as well, then they could become, if you like, a systemic problem, which I think they try and cover up. They must try and cover it up. I think it would. I mean, it's not impossible that a bullion bank will get into difficulties, but I think it's more likely it's amongst their clients that the difficulties will arise. That would be my view, anyway.
And if that occurs, what are some of the first and second order effects of that?
Well, within the COMEX rules, they can declare force majeure, but nobody's going to want to see that at all. I think what's likely to happen is there will be a rescue behind the scenes. We won't know about it. It'll be hushed up. It'll be very, very quiet, but it will happen. And it wouldn't surprise me if that happens quite soon. But, we're not to know about it, because if you get a failure in these markets, particularly gold and silver, this could undermine the whole of the derivative industry. I mean, because we're not just talking about, those derivatives. I mean, they are central to everything. Just think about the Exeter pyramid, with gold at the bottom supporting everything else. I mean, that might exaggerate the position a little bit, but you can see how important gold is in all this. And if you get a failure in what is actually legally money and all else is credit, the failure in real money counterparties, then, this is serious. You've got to bear in mind that the market has moved. It's now over in Shanghai. I mean, the physical market's over there, not over here.
So does that imply that futures markets, like the oil market, the rest of the commodities market, those paper contracts, those paper derivatives would pretty much, essentially, the prices for all of these commodities would just soar through the moon?
Yes. Oh, absolutely. I mean, it's in terms of, if you like, contagion from gold and silver derivatives. Yeah, I mean, you've got the same counterparties operating in all these markets. So you are going to get that contagion, if you like, spreading across. And it's not just those markets, because once you spread from gold and silver into other commodities, you also, going into counterparty failures in the other really large derivative markets. And even in foreign exchange and things like that. So, it's got to be stopped, basically, and they will stop it. But as to your point about commodity prices rising and all the rest of it, I would note that gold is leading the way upwards in commodities. And my view is that it's likely to drag other commodities like base metals, for example, and energy up with it. But particularly base metals. I mean, they are, relative to gold, they are now cheaper than they have ever been. And since gold is the real money standard, as it were, even though that's being driven up, if you like, by markets, I would see that all these relationships are going to come under huge, huge strain. And it's not good for the purchasing power of paper currencies.
Understood. So we've got about a few months left in the year. What do you forecast ahead for the next 3 months or so? What do you see by year's end here?
Well, I think there's an increasing likelihood that the credit bubble will burst, come to an end. Now, if that happens, it's going to unleash, I think, some major developments in the markets. I mean, apart from anything else, something like a 1987 style crash, or a 1929, October 1929, both October, incidentally. This is quite a dangerous time historically. That style, that sort of scale of move down is going to create huge, huge, great problems, because the amount of leverage in the market is at record levels. I mean, just look at the figures coming out of FINRA. I mean, the end of August, the level of leverage was about 1.2 trillion, I think, from memory. and that's up 4 or 5 times since over the last 10 years. This is huge leverage in the markets. That gets unwound very, very quickly. And you find that, so, while, if the market drops 25%, say, when it starts, then, a lot of these leverage positions are going to be just completely blown out of the water. And the experience of a deflating bubble, particularly when you've got the complexity of tariffs put on top of it, trade tariffs and all the rest of it. I mean, it's just like 1929, and this is not good. But this time it's even bigger. It's bigger than 29. I mean, a lot bigger. So whether it happens in the next month or two, I don't know. I think it's quite likely to happen by the year end. And then, of course, that's going to have a huge, great impact on bullion, because if you think about it, I mean, every market's going to be in the same position. Some people will have, think they got wonderful profits in bullion and they'll cover the losses by selling bullion. But apart from that short-term effect, what we're likely to see is a flight out of paper into physical bullion. I mean, just get the hell out of paper. It'll start in the financial markets, that move. So it would drive, and think of it from the point of view of a large investment management organization with their clients holding no gold at all, which is par for the course, long up to their necks in tech stocks and whatever. When that starts collapsing, where do they go? I mean, the answer is they try and get out of the falling stocks as quickly as possible, and anything where they can sort of rescue something. But on the margin, they're going to be saying, well, the one thing we haven't got is bullion. We've got to get into safety. And I think that's what the foreigners will do, probably more, initially anyway, more than domestic institutions. The problem is, Danny, that there just is not the bullion there to satisfy the potential demand coming out of institutions. And we should note that analysts at the big banks are now forecasting higher gold prices. But their investment managers haven't got any. So what do they do? I mean, where do they go? If you look at how much gold is really required to satisfy just 1% of portfolio allocation across the world, you're looking at 25,000 tons of gold at current prices. Now that is just not there, because China's cornered the market. And nobody else wants to let it go either. I mean, okay, there are a few traders and so on who will let it go. But, if we're talking about physical, and we're not talking about paper, we're talking about physical, it's just not there. And the paper market, what does the paper market do? I mean, basically, what we can see is a likely major move into metals because they are performing, gold and silver anyway. And because it's not there, prices go through the roof, crisis ensues. So I think this is the danger. I mean, I think it would be dangerous, I think, for me to forecast this as such. So I don't come up with forecasts, but I just look at the dangers, if you like, that are likely. And this, to me, is the big danger at the moment. Nobody's got gold. Nobody's got physical gold in the West. They're running an awful lot of portfolio money. And at some stage, they're going to try and move over. And when you've got, people like Goldman Sachs saying, we expect gold to go to 4,000, whatever, by the end of. I mean, I don't know whether they're talking any sense at all. Probably not. They're probably just looking at the charts. But you can see how, this actually leaves the investment managers who got none in a bit of a pickle. What do they do about it? And the gold isn't there. They can't get it. I mean, you've got parties who we don't know who they are, who are standing for delivery on COMEX as the only way in which they can get any physical. And so far this year, I mean, it's been, I reckon it's about 950 tons has been stood for delivery on COMEX this year alone. By the end of this year, it's going to be well over 1,000 tons, probably closer to 1,500, I think, the way things are going. There was a very big delivery yesterday, 66 tons or something, and silver also. COMEX wasn't meant to be for this at all, but yeah, people are using it as a means of getting bullion which they can't get elsewhere.
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as a pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020. And once these hedge funds really started piling into the precious metals trade, I would suspect that they would pile into the likes of GLD and SLV and so forth. But as you've kind of hinted,
no, you did right. That's the easy way to do it. You know, I don't know where to get this stuff. I'll just go and buy GLD, and they can have the damn problem. So, yeah, I mean, I think the ETFs are growing in size, but I think it's only just started. People they haven't realized that gold is, in their terms, in a bull market. In my terms, the currency is actually in a bear market, which is actually far more serious. They haven't really understood it yet, but they're sort of gradually waking up to the fact that, they don't really know why, but they really should have some gold. It's the only game in town. So, they will go. I mean, and the same with SLV. I mean, it's going to put huge strains on, the combination of COMEX and London. That's for sure, because it's just not there. So where does the manager of GLD go for it? It's going to be interesting.
In terms of risk reward, where do you see the most promise when it comes to the three precious metals being gold, silver, and platinum? How would you kind of rank those three? If you had X amount of dollars to invest, how would you kind of allocate that capital across those three metals?
In terms of preference, silver every time. At the moment, with a gold-silver ratio of 81, 82, whatever it is, that I think has the potential to fall below 50, which basically means it will outperform gold. There's a huge catch-up element, I think, to be done in silver. And as confidence gets drained out of fiat currencies, then I think moneyness will come back into silver in really quite, to quite a large extent. I wouldn't be surprised to see silver with the gold to silver ratio going back into the sort of 30s, that sort of level. I wouldn't necessarily see the sort of levels which Sir Isaac Newton tried to fix it at sort of 14.5 ounces of silver to 1 of gold. I think that's too much of a stretch, because I don't see it really going quite that far. But what I do see is I see it going into the 30s, and I think I would revise my opinion after that, I think. Sorry.
And then between gold and platinum, how would you rank either one?
Gold every time. Platinum is not a precious metal. What we're talking about is getting out of credit and getting into real money. Platinum isn't priced as money; it's priced as a precious metal, which is a different thing. Jewelry, trade, and industrial applications. Now, having said that, if I look at the relationship between gold and base metals have been left way behind in this, and I would expect them to catch up. But I think that's all part of 2022, 23, when we see the purchasing power of currencies declining and declining very, very sharply. We'll see copper, we'll see nickel, we'll see steel, all the rest of it, all those things rising in value in a way which people find very hard to explain, because they don't understand that it's not demand driving silver and copper so much. I mean, obviously demand is important, but really where it's coming from is a collapse in the purchasing power of the currency, which is actually what, people think inflation is rising prices. No, it's not. It's falling purchasing power of the currency. It's the most important lesson anyone can learn. And we're beginning to see that in gold and silver. And it will drag the whole of the rest of everything, if you like, into higher values measured in declining fiat currencies.
Is there a risk of systemic bank failures, based off of what we just talked about today?
Yeah, there is. But I think we're moving away in this conversation from derivative markets in particular. Because banks obviously have exposure to zombie companies in the economy. Those zombies are going to fail. Why will they fail? Because interest rates or bond yields will continue to rise. I think I've said on your show before that I remember the 1970s when we had gilt issues with coupons of 15.5%. Those conditions are returning, and I don't see it stopping at 15.5%, because governments have got themselves into debt traps. And as they get themselves into debt traps, and as the purchasing power of their currencies go down, what does a lender to the government require? He requires a higher bond yield to protect him against his expectation of lower purchasing powers. And it's going to it's just going to collapse the whole thing. I think, basically the function at that stage of the Fed and the US Treasury, and the same incidentally is true also in other countries, other G7s anyway, their basic function will be try and underwrite everything. And what that will mean is that the amount of credit and debt in the situation will not contract. It's just their value. Their values will decline. Their values will effectively collapse. That's the way in which debt gets wiped out, collapse in its value, not through permitting, zombie companies and all the rest of it to just go under. That's the other way. That's what happened in 1929 to 32, because some 10,000 banks went out of business, money supply contracted. Of course it did, because it was, debt was being wiped out along with the matching credit. This time round, there's the basic function of government today is very different from 1929 to 32, and that is to protect everybody. So, if you're a small local tradesman, then nobody gives a hoot. But, if you're employing a lot of people, the government does give a hoot, and they'll stop you going out of business. We've already had this actually this week in the UK with Jaguar Land Rover. They had a cyber attack, and basically it's meant that they've had to stop production, and an awful lot of their suppliers are being put out of business. So what does the government do? It turns around and it injects money into JLR to try and keep it going. So, we're going to see a lot more of that, I can assure you.
So we recently cut rates to the tune of 25 basis points last week. And as a result, we've seen a little bit of I don't want to say a little bit, but not really much movement when it comes to the 10-year and 30-year Treasury on the U.S. T-bonds. Why are we not seeing any correlation between the Fed funds rate as well, with respect to the long end of the yield curve?
I think part of the answer is that the investment community, the macroeconomic boys, don't actually understand credit. All they see is if you get a lower interest rate, then bond yields come down. But what's happened is they haven't gone up, basically. They did actually go up slightly on the cut, which sort of rather tells me that, people who sort of, they bought bonds a little bit ahead of the cut and then they took profits on the cut. But as I understand it, there's still something like a 90+% bet that there are another 2 rate cuts due by the end of this year. So, I mean, the whole thing is sort of, it's just got stuck, I think, is the answer. And, people just don't realize, actually, this is a very, very negative thing. I'm not saying that the Fed has an awful lot of alternative, but, to cut interest rates when, inflation, and we know that inflation is considerably more than the CPI level. But when that's not coming down, I mean, it's not a time to cut interest rates. So what the Fed is actually saying is we have switched from trying to control inflation to trying to stop deflation. They're trying to stop the economy from sliding. They're looking at jobless figures rather than inflation figures. And the inevitable consequence of that is that, when the crisis comes, they'll be just completely wrong-footed. And again, from Fed's point of view, if they've got to start rescuing everything, they're going to want to see the rates down. And so, incidentally, is Mr. Besant at the Treasury, because he's going to have to be borrowing an awful lot. And, basically he's borrowing, if you like, in the T-bill market. And if the Fed could cut rates a bit, it would suit him absolutely down to the ground. So it's all pointing to lower rates at a time when the purchasing power of the dollar is on the verge of collapse. That's what gold is actually telling you. The purchasing power of the dollar is going down a lot more than you think.
And
is this a good time to cut interest rates? Interesting question.
It kind of echoes 2020 when you really think about it, because gold started to run in 2020, and then a year later, the rest of the commodities started to run afterwards. And then you started to see, at that time, we cut interest rates near zero as well. We're nowhere near zero right now, but the attitude, the desire to cut interest rates a significant margin is there. You recently had these comments from one of the members of the Fed board the other week saying we need to cut down to 2% from our 4% levels today. So that's 200 basis points. It's a pretty ambitious goal. But if they do that in conjunction with gold moving upward as it is, it's kind of weird, because you recall 2020, these kinds of things led to a huge market upswing. The stock market went to new all-time highs after the COVID crash. But then you look at other times in history when the Fed cuts rates or begins cutting rates, it usually precedes a market either sell-off or crash. Which direction do you anticipate interest rate cuts take the markets this time around, given the current conditions?
Well, I think your comparison with the sort of COVID time, I think is a good one. But in general, the way to look at it is that we are in the biggest credit bubble in history, and if you don't appreciate it as a credit bubble, and I can tell you most people in the market don't understand this at all. Just look at debt, because debt is the other side of credit. For every debt, there's a credit. And undoubtedly, we are in a debt bubble. This is bigger than 1929. The point about credit bubbles is they always go pop. I mean, the difficulty is knowing when they go pop. Someone who sort of calls it early looks an absolute damn fool, because prices can double, before he's right. So that is the trouble. That's the difficult thing. So you have a market, really, where everybody's got to play, because if you're an investment manager, to take a value view and stand on one side, you're just going to lose business. You have to go along with it. So you've got a market which is purely being chased by momentum, not value. And if you look at cryptocurrencies, they are symptomatic of this attitude too. When it turns viciously, and suddenly it just goes. I think the key this time will be the next rise in bond yields. I mean, we've just discussed, sort of got this sort of interim bit, as it were. I think that what we will get is we'll get a rise in bond yields, and it's that will pop the bubble. I've seen this before over several credit cycles. You get the initial rise in bond yields, and the equity markets continue to rise with them. And the reason they continue to rise with them is that it becomes apparent at that time that things are good. The economy looks all right. Fears of recession are overblown, and the credit is being angled by the banking system at rising asset values, which is precisely what we've got at the moment. But very often what happens is that you find that there's a pause in the increase in bond yields before they go higher. And it's that second run which nobody expects. When bond yields go higher for a second time, that's when the bubble gets popped. And this time, we've got this same thing that we had in 1929. We got the Smoot-Hawley Tariff Act Mark II on top of the credit bubble. And the timing of that was catastrophic. I see no reason why the timing of Trump's tariffs on top of the credit bubble will not be equally catastrophic. So I think that's the thing to watch for. Just watch those bond yields. And when the long bond yield starts sort of going through sort of 5% and, threatening 5% and so on, I think at that stage, markets will begin to really pause, if you like, and it'll be, like sort of lemmings on a cliff edge. Everybody will be then jumping down as it breaks through, because these yields are going to go higher. I mean, the thing to understand is that it's all about compensation for risk. And, foreigners have got over 40 trillion invested in US financial assets, which about 16 or something is in equities. Are they going to hang around and, just think, well, it's, we're loyal to the American equity market and we've made money in the past, so we're going to stick with it? Do they hell is like? When the tide turns, they get out very quickly. A lot of them will just lose huge amounts. But if you're going to lose anything, you don't want to lose it in foreign markets. You don't want it to be in your domestic market. So your foreign investments are the ones that get sold down first. That's undoubtedly going to happen. Now, America is badly placed for this because foreigners have enormous exposure to the dollar, whereas, if you like, Americans don't have very much exposure to foreign currencies. The reason for that is that they've been lending dollars, their own currency, out to other countries. They don't own foreign currencies. And when it comes to investing in foreign equities, it's all done via ADRs. In other words, they don't actually have any currency exposure at all, in the sense that, if they sell an ADR, they don't have to sell the currency at the same time, whereas a foreigner does. So the dollar is uniquely placed in this, and it's bad. It's bad.
Yeah. Well, I think that's all we have time to cover for today here, Alasdair. Go ahead and take us home. Anything else you want to talk about briefly that we didn't get into? Otherwise, just go ahead and tell us where people can find you if they want to see more of your work.
Well, yeah. Basically, I've got my own Substack, as indeed you have, Macleod Finance Substack, which I see you've got here. If you want more misery out of me, then subscribe.
All right. We'll have the links to your Substack down below, so check it out, guys. And if you got value out of this podcast, drop us a like and comment, "Go, Alasdair, go," in the comments section. If you agreed or disagreed, either way, good or bad. Let me know your thoughts. I do, in fact, read all the comments. So drop your thoughts down below. I will read them at the very minimum. I will respond to a few of them, but I can't get to all of them. And subscribe to the channel so you don't miss an episode. And by liking, subscribing, commenting, doing all the YouTube stuff, you do help in pushing this channel and this video up in the algorithm. So if you'd like to support me that way, it's easy, it's free, and a little bit does go a long way. It may not seem like it, but it certainly does. And if you'd like to support me monetarily, then check out my Substack at capitalcosm.substack.com to get access to all of my stuff early, ad-free, and uncensored. And so with all that said, I appreciate your time, guys, and I will catch you later. Bye.